Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. If you are joining us for the very first time, welcome and thank you for becoming an Equity Mate. If you're still getting up to speed with the basics, you can check out our Get Started Investing podcast. But let's crack on for today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm excited for this interview. We have a returning guest, a returning favorite, Nathan Bell from InvestSmart, and we're going to be diving into two companies. Last time, I believe we only spoke about Australian companies. This time we're going global.
Yes. So Nathan Bell of Intelligent Investor. Nathan, welcome.
Thanks. I'm glad you said Warren Buffett status and not age.
We are actually going to go and see him over in Berkshire, in Omaha for the Berkshire conference this year. Given both of their ages, we felt time might be running out. So have you ever been, Nathan?
I have been a couple of times. What we used to do in my old company was whoever was basically the last analyst in, who was typically the youngest analyst, had to get up at 4 a.m. and go and line up and save seats for everyone else. It is the single worst job you'll get as an investor in your life. Trying to hold 7 seats in an auditorium that's going to fill up twice over for like 3 or 4 hours while everyone's trying to pitch those seats is a nightmare.
Gee, see, we haven't even thought about that. We just thought you get a seat on your ticket and you roll in. But if we're going to have to be sending our juniors to, nice.
Let's get into the interview today, and we're excited to have you on because Intelligent Investor are launching a new fund, the Intelligent Investor Select Value Fund, ASX ticker IISV, which is an actively managed ETF of about 20 or so global industry champions and market leaders. And so today we're here to talk about two of those global industry champions and market leaders.
Yeah, so let's kick off. We've got a couple of companies to dive into, and then pending time, you did mention that you've got so many stocks in your head that you need to get them out.
I think you promised one international bank that makes the Australian banks look very expensive. So even if we don't have time to delve into it, we'll get you to give us the name at the end of the interview.
So the companies, the fund is made up of about 70% international stocks, and we'll touch on the purpose of the fund in a moment. But let's start with the first one, Nathan, which is Mastercard. Now, if you have been living under a rock, let's just start with what is Mastercard and a bit of a history, and then we'll get into the bull case and a bit of the nuts and bolts.
Yeah, so Mastercard shares a duopoly basically on the financial transaction rails of the financial system with Visa. And the history goes back to actually the late 1950s. So these companies have been around for a while. And it started with the launch of the bank Americard, which was it would eventually become Visa. And a bunch of financial institutions got together and said, well, we're going to launch our own card. And that's eventually what became Mastercard. Now, unbelievably, Mastercard listed in 2006. And I clearly wasn't paying attention because the stock is up about 100 times since it listed, which is just phenomenal. And this is what I really want to, this is why I picked Mastercard. I could have picked, there's a whole bunch of incredible companies you just can't find on the ASX that we could talk about. But I just thought this one in particular, it's easy to understand because people are probably customers of it. You know, basically everybody has a Visa or Mastercard. And the business is actually quite simple, but it's also your classic Warren Buffett stock. And again, it shows that when you buy that quality that's just got these impregnable competitive advantages that competitors just can't compete with, you know, and you happen to be in the right spot at the right time, you know, with this switch to digital payments, you know, the returns can be absolutely phenomenal for low risk. And that's what I really trying to tell people what this fund is about, because I think so many Australians have thought about investing overseas or can see the writing on the wall for stocks like Woolworths or their banks whose share prices haven't gone anywhere for over a decade now. You can see that there's no growth left in those businesses and go, okay, well, there must be these I know these great businesses exist overseas, but it's too time consuming. I'm too afraid to go over there. It's too much work, or it's too complex, or I see all these strange Asian companies and CEOs going missing and all this sort of stuff. And so that's what this genesis for the fund was. And so Mastercard is typical of that. It's just a very simple business that we understand, where they take a small charge on our everyday purchases, and those pennies essentially add up to, at the moment, about $10 or $11 billion in net profit. This is an absolute financial beast, this company. So the previous CEO, who was there from about 2010 to 2021, is a guy called AJ Banger, and he was quite a lively personality, so he was quite well known. And he was there till 2021, and so I think in that decade, revenue increased fivefold and net profit increased fourfold. So this is a $380 billion US dollar business, so nearly half a trillion or over half a trillion Australian dollars. So it's a really big company, and yet the net profit is still growing in the mid-teens. So, you just don't find that in Australia. You just don't find these type of businesses particularly growing that fast. But the net profit is a ridiculous 45% of revenue. So like almost half of revenue falls to the proper bottom line. And if you look at in Australia, for example, where CSL or REA Group would probably be hung out there as by far and away two of our best businesses, and extraordinary margins, particularly in those property classifieds businesses. Even their margins are 20 or 25%, and they're the absolute pinnacle of what you can find in Australia. So this is an absolute monster that's still growing quickly at $350 billion market value.
So Nathan, let's just stop there, because I think a lot of people across what Mastercard is, they've seen it on their credit cards or their debit cards, and most people are familiar with the duopoly that exists in payment rails between Visa and Mastercard, and both have been incredible investments and incredible businesses. And as more and more of the world gives up cash and moves to digital payments, it feels like they've got long growth runways ahead. And you've just told us that they have Mastercard has a 45% profit margin. It did $9.9 billion in profit off $22 billion in revenue, which is astounding. Some of the best profit margins in the world. The obvious question out of all of that becomes, why aren't there other companies entering this space, trying to bust up the duopoly and accepting a 30% profit margin or a 20% profit margin and trying to undercut these two giants?
So the two big risks is the competition, so we can talk about that in a second. And the other one is regulation. So if the government came in and put a cap on the prices or the fees that Mastercard and Visa could charge, that's the other big risk. And they've actually tried in the US to make that happen. And it's happened for some particular client groups, and Mastercard and Visa have just offset that with putting up their fees elsewhere. So, but that is the big risk to me. The reason the competition hasn't been able to take them on, because American Express is essentially the third player. They essentially have their own network, and it's a different business as well, because they've actually got a bank within Amex. So it like they take the credit risk. So all Visa and Mastercard do is just charge the transaction. That's it. Whereas Amex actually lends money, so that creates a very different business. Very capital intensive when you have to start lending huge amounts of money, and that's why you don't get as big a profit margins. And then you also have to worry about a recession if all of a sudden people can't pay back their debts. So that's really been the third main competitor. And if you have a look at Afterpay, all these sort of BNPL companies, I'm sure everyone's familiar with, they've been very popular with young people who have been steering away from credit cards, mainly because I think there's just a bad feeling about them generally, that they're taking on debt, and they probably see a lot of adults who have got too many cards or have borrowed too much money. And BNPL just seemed to be a much more modern approach, smaller amounts. But I think what you're going to see on this particular competitor over time, and I may be wrong, but one, the BNPL sector is not even profitable anyway, so I don't even know whether it's going to really last as a service. But the one thing it does do well is it actually provides the retailers with good information about what's selling, and it shows that the average person who has a BNPL spends more money with that buy now, pay later account than if they didn't have it. So that's a positive. But again, you've got some credit risk if people aren't paying back their the money because they are actually borrowing money technically, even though the BNPL sector says otherwise. But actually what happens as you get older, there's a massive network where an absolute global network of merchants signed up to Visa and Mastercard. And that takes a lot of time to put together. So yes, you've got to own the rails, but you've got to sign up all the customers. So it involves a lot of marketing as well, and just a lot of walking the pavement to sign everyone up. So it's expensive, and so you've got to do all the marketing as well. And then I think about myself. I'm 47 years old. I pay off my credit card every month just with a direct debit. Like I don't even have to look at it. But what I do get value out of is the points system, and I get a whole heap of free flights each year, and it's worth it. So it's worth paying the $350, I think, annual fee. So you've got this whole ecosystem that comes off the cards that no one else can compete with, in addition to not actually having to build the network. Because if you're actually going to go and build the network, like that's going to cost an absolute fortune, like an enormous amount of money that no one's going to bother spending, because then you've actually got to go and outmarket, outcompete, and create the whole international ecosystem and industry from scratch. And it's just a monumental task. And that's why you've got companies like Apple Pay, who essentially just ride the rails, and they just rather get a little clip of the ticket rather than spend $1 zillion trying to compete. It's just too expensive.
When you think about Mastercard, it's, as you said at the top, it's one of just those big stable sort of earners that is just improving its profit year on year. Where do you, or what do you factor in over the next 5 years or so from a growth driver point of view? Is this just a story of trying to get more and more market share from its competitors? How do you see revenue growth over the next sort of 5 years?
There's a couple of things here. So, and we can actually bring portfolio management into it, which is a really important part of looking at these stocks, because they look like the perfect stocks, right? You say, look, this stock is so good and it's priced reasonably. It's in the mid to low 30s as a PE price to earnings ratio at the moment. In a couple of years, assuming the growth that everybody expects comes through, it'll be in the low 20s. So you'll own this absolutely world's best business in the low 20s if you're patient for a couple of years. And that's a really nice outcome, for a business that should be able to grow in the teens for, indefinitely, basically. But you've got these big risks, around regulation, which you can't get rid of them. But the question is, would you run with 50% of your portfolio in a company like this? Or maybe if you've owned it since 2006, you might, and just hang on to it and let your profits run. But from a professional funds management perspective, and there are a lot of funds that actually have a lot, 10% plus of their portfolio in Visa and Mastercard, because they've just been so good and they just keep trimming them as they go along. But the reason they trim them is because you just never know when one of these big risks could come up. And if you've got 50% of your portfolio and all of a sudden they're worth half, that's a hard thing to explain to your investors. So I think what you can do with these businesses, no matter how good a business is, you've got to have some sort of limits on your portfolio management. Maybe we end up going with 5% in Mastercard and 5% in Visa, because you just can't get rid of those risks.
So, Nathan, we've spoken a little bit about Mastercard. You've touched on management, you've touched on growth and the competitive threats. I guess the question, to sort of wrap it all up and, to really understand why, Mastercard has been a great investment since 2006. It's made a lot of people a lot of money, but that's all old news for investors, for yourself looking at Mastercard today and thinking about putting it in your portfolios. So what does the company look like in 5 or 10 years if management can execute? Is it radically different to what it looks like today, or what vision underpins the thesis?
Sorry, come back to your previous question as well. The difference between Visa and Mastercard is that sort of roughly these numbers, but roughly 2/3 of Visa's business is in the US and the other third from around the world. And Mastercard is the opposite. So Mastercard typically trades at a bit of it's only a small premium to Visa, but it's because the market thinks that there'll be more growth overseas than there will be in the US. And you can argue about that, but I'd say that should be true. So the thing about this company is, we don't actually want it to change. If there was some sort of massive technological hiccup coming our way that maybe required a massive investment or was going to threaten those gigantic profit margins in Mastercard, then that's something really to worry about. And again, you might just factor that into your portfolio management and just make it a smaller position. Rather than carrying 5 or 6, maybe it's a 3 or 4% position if you thought those risks were higher than what we do. But it's really just more of the same. We're not trying to reinvent the wheel here in any way. This is, when I talk about Mastercard, I feel like I'm like all those fund managers talking to you about CSL. I'm sick of it. Everyone says it's a bit like the old days where if you bought IBM, you never lost your job.
Well, for people listening who think that Nathan's just talking about a stock that we've all heard of before, I can assure you the next one that we're about to speak about, most people won't have heard about, to the point where Bryce and I were figuring out the correct pronunciation before we started recording.
That's because we were given to us with a spelling mistake.
Yeah, well, that kind of ruins the mystery.
But that's a good lead up. As we said at the top, the fund IISV is made up of international and local equities that Nathan and Intelligent Investor team believe are trading at undervalued prices. The fund is still at an expression of interest stage, so it's important that you register your interest so that you can get the priority access when the initial offer opens. The link for that is in the show notes. Now, we're going to just take a quick break, and on the other side, we're going to dig into a second stock that is part of this portfolio. So we'll be right back after this short break. Now, today, Ren and I are joined by Nathan Bell of Intelligent Investor, digging into the idea and concept behind the Intelligent Investor Select Value Fund, ticker IISV, an actively managed ETF of about 20 or so global industry champions and market leaders. Now, Nathan, before we jump into the second stock, can you just touch on the international coverage of the fund and why you've launched it? Like, we see fund after fund come to market and really like to understand how it's different to some of the other international funds that are out there.
So there's a whole bunch of reasons, but one of the things that really frustrates me is I see all these fund managers, and it's becoming increasingly so, where they've got a stable of funds, and the best fund by far in terms of outperformance, and maybe often it's actually their only outperforming fund, is the fund that can actually invest overseas and own some Australian stocks as well. But I think it's becoming more common as well, because I think people are starting to open up a bit more to overseas stocks generally. So there's a combination of trends there. So with the outperformance on our existing trio of funds on average, I think is about 3.5% per year. And there's some pretty heavy restrictions on those funds. I mean, one's an income fund for a start. And I think I can't find an income fund that gets anywhere near to the outperformance of our funds over the same time. Like, it streaks ahead, and it's not based on a BS benchmark, like including franking credits in your returns and not putting the franking credits in the index, all that sort of nonsense you see everywhere. And one's an ethical fund. So again, huge restrictions on the sort of stocks it's can own, and yet we've had that great outperformance. So the reason I really wanted to create this fund is because being able to buy these wonderful businesses overseas, plus combine them with some of our best small cap ideas in Australia, that just creates the best possible opportunity to outperform of all our funds. And as I keep repeating, but I just think people are finally starting to appreciate, because they use Google every day, and because they see Apple, and they're just seeing how good these businesses are, and because they use them every day, I think it's just become they're just a lot more open to it, along with the frustration probably of the poor returns of some of their long-held Australian stocks. But one of the things that's been holding us, or the thing that's been holding me back, is it's one thing for me to run the fund, but we have a subscription service, which I'm sure a lot of your listeners have heard of or tried before at some point. And to introduce 20 new international stocks and cover them on an ongoing basis every day is a huge task, and I just don't have time for that. So I've just been restrained in that way. And so we hired an analyst, Nick Cummins, who is 100% responsible for this next stock we're going to talk about. So if you don't like it, blame him. And he's able to write up all these stocks and keep people abreast of them. So if you're the sort of person that has no interest in the fund, you want to do it yourself, but you've just been waiting for someone to hold your hand and cover these great businesses, then Nick's going to do that for you. And I think April 7 will kick off the subscription service.
And we should just clarify, Nick Cummins, not the honey badger.
He's not. He's a redhead though.
Yeah. So let's get into this second stock, because as we were saying, Bryce was pronouncing it Floor and Deco, and I was pronouncing it Floor and Decor. A company that we hadn't heard about before, also listed in the US, New York Stock Exchange, ticker FND. So Nathan, to kick us off, can you tell us a little bit about Floor Decor?
I can. So I'll get the names right here. So the company was founded in 2000 by a guy called George West. And George actually had a family business. And I don't know if it was just one single building supply store, but his parents had it. And the story goes that he was very frustrated when he was doing his own bathroom renovation. And he said, there's just got to be, better options than what there is. And so he got into specialty flooring. And today we've got 170 stores across 36 states. So it hasn't been around very long. Like, this isn't the Mastercard story where you're going back 60 or 70 years. This is a fairly new business. And it does specialize in flooring and building supplies. So the building supplies heritage is obviously there from his parents' shop, but it's really about the flooring. And the difference in this business compared to what exists out there is it's a specialty store, and typically the industry has had companies like your Home Depots and Lowe's, which are the Bunnings equivalent in the US. Tremendous stores in their own right, to tremendous shareholder value creators. And they don't specialize in flooring. And the other shops that tend to specialize have just been much smaller. Floor Decor stores are 20 times larger generally than any competing offer. So when you've got, I think it's about 2,600, if I've got it right, 2,300 hard flooring stock options in these stores, like, to say it's comprehensive probably doesn't do it justice. But here we are. Like, you think, you're in America, which is an enormous country, and you've only got 170 stores rollout. So it just shows you how early stage this business still is. And the CEO now, who's a guy called Tom Taylor, who actually has a history as a very senior executive at Home Depot. He started out as a 16-year-old and worked his way up there. And he didn't get quite to the top, but very senior roles for a very long time. Looks like he spent 6 years. I think it's like a venture capital type business, and obviously got sick of listening to pitches. Or maybe it had something to do with the GFC, and maybe there wasn't many pitches to review anymore. And he wanted to get back into a managerial job, so he took the CEO role at Floor Decor. And his current aim is to get that 170 store network up to 500 stores by 2030. So big aims for the company, but this isn't a mature company like Mastercard. Has a similar price to earnings ratio, but obviously a very different business and a very different set of financials.
Yeah, well, I wanted to touch on that. So for a company like Floor Decor that is a lot earlier, less established, I guess, than the Mastercard, as you just pointed out, how do you look at the financials differently? You spoke about Mastercard, you're just looking at that revenue growth and also profit growth now, just how much they can put to the bottom line. Is that as important for a company like Floor Decor, or what specifically are you looking at to, I guess, keep proving that your thesis is right here?
The secret to looking at the financials is to understand that only 30% of the stores so far are more than 5 years old. All right, so the network's actually even sort of younger or more in its infancy than it looks. And the reason that 5-year target is important is because that's what they consider a mature store. And a mature store is twice as profitable as a new store, as you'd expect, because it just takes time for a new store to ramp up. So, you can sit there and you can just, you can build a simple spreadsheet. You can have some sort of estimate of what you think a mature, profitable store earns. And then you can just quite simply, do the rollout. Let's say they hit their 500 stores over the next 7 years, work out what the maturity of each store is over those years. And, you'll come up with a discounted cash flow, big giant spreadsheet, and it'll probably say that the share price is going to be worth 3 or 4 times what it is today. That's exactly why we're in this. But I just don't think you need to be that specific at this point. And I'm always, I'm not a big fan of spreadsheets, because I think all they really do is create more mistakes, more potential mistakes. And in my experience, what they've done is actually made you sell the great businesses far too early, because the great businesses, they just surprise you. Just use an example like ARB was a four-wheel drive accessory company that before COVID, earnings per share was stuck at 70 cents, and all of a sudden they sign a couple of, and those EPS have really gone nowhere for ages. Then all of a sudden it comes out, announces a couple of new contracts, and all of a sudden earnings per share has doubled. You can't put that sort of stuff in a spreadsheet. So I sit there and look at Floor Decor and say, okay, well, this thing's trading at low 30 times, and if those stores, the existing store network matures, then you're going to own a store at under 20 times earnings just from the existing network pretty soon. So basically, if you're happy owning that, if you think these are sustainable stores, continue to be, profitable for a long time to come, and you're starting on an earnings yield of say 5%, which is, the equivalent of a price to earnings ratio of 20. So it's just the earnings yield is just the flip side of the PE ratio. You've got a nice growing business there that should at least grow by 3 or 4% a year for a long time. So there's your 8 or 9% return based on your existing network, and essentially any bonus you get from the other 350 stores that are coming is all gravy.
So Nathan, when I look at a company like this, how big is the market for hard surface flooring is instantly where my mind goes, and how sexy can a business like this be? And the analogy that comes to mind, if I'm thinking of an Australian company, would be something like Nick Scali. How big can the market for furniture be? There's other competitors for furniture, but you look at Nick Scali and it's a story of founder-led execution in a pretty unsexy category. And I guess the Floor and Decor story, if it plays out, will be something similar, that, this becomes a giant in hard surface flooring. But I guess you do have to just wonder, like, what's the natural limit for a market like this? They're targeting 500 stores. They've seen great revenue growth so far. How big is the market? And, even with the best execution, can this market support 500 large format stores in the US?
Yeah. So, there's 330 odd million people in America. And at the moment, this company has got is only in, 36 states. There's 170 stores. So really at the moment, that's only, not that this is where the stores are, but that's only 3 stores per state. So the bottom line is it can handle a lot more. I don't know whether 600, 700 is the limit, but, and maybe they don't get to 500 as quick as what they are, because that actually requires a lot of investment, and that's a far more rapid rollout than what they've had in the past. So that's probably where my interest is more at the moment, is on how much money it's going to cost. Are we going into a global recession? So does that slow down the rollout? Are they going to have to focus on profits just to make sure they've got the capital to be able to roll out those stores over the longer term? So I'm less worried about maxing out the market at the moment, because we're only paying low 30 times. I know that sounds high for most businesses, but when you're talking about tripling the stores, low 30 times is nothing. And that's why, the market's prepared to pay a big multiple for Lavisa, for example, at the moment. People can see it's growing. All of a sudden, the new CEO's come out and said, we're just going to open up stores everywhere. And, the market's buying it. Everyone's excited. So it's the same thing. But there's one other aspect to this investment case that I think is really important, and probably not well understood by most Australian investors for obvious reasons. And that is that America actually has its current population of sort of 25 to low 40-year-olds, like essentially the millennial population, even though I'm told millennials don't like being called that, but whatever you want to call that population cohort, is the largest population cohort in American history. They are your key home buying and building years, family starting years. And so you've got that huge demographic tailwind for this business. The average age of a home in America is 39 years old. So there's plenty of renovation to be done. And this is a really important point, is that the mortgage market works very differently in America to what it does in Australia. So basically, when you take out a loan, it's fixed for life, but only for that property. So at the moment, everyone's interest rates are going up, but not mortgages in America. Like, everyone's still on the 3%. And that's why, like, the transmission of these higher interest rates in America is so slow. They don't have variable rates like they do in Australia. So you've got all these people who, for the next 10 or 15 years, are going to be stuck in their house, whether they want to move or not. They're only having to pay a 3% mortgage rate. And if they move, they're going to have to pay 6 plus. It's going up. So maybe it'll be 7 or 6.5 or 7 very shortly. So obviously they're going to stay in their home, and they'd much rather spend the money and renovate their home. So flooring is just becoming an increasingly fashionable thing. I think in the past it was just more of a, just do whatever we need, hard white tiles if they're my parents' place, or, easy to clean, whatever it is. But these days the flooring is actually becoming the absolute highlight of the house. You're seeing all the chevron flooring and all that, which is much higher margin revenue for this business. So that's what I like about it. It's not just the store rollout. I just really like the tailwinds blowing behind the industry generally.
Now, Nathan, one final question around, I guess, the moat that Floor Decor has and the competitive threats, because I've just Googled Home Depot flooring, and they do have a flooring section, and it says the Home Depot really is your one-stop shop for all your flooring needs. Now, for people who are unfamiliar, Home Depot is the Bunnings of the US. It's a giant in this sort of, home renovation, outdoor space. How do you think about the threat from Home Depot, and how does Floor Decor continue to, I guess, differentiate and beat them?
So these guys have always been there, right? These, like Lowe's and Home Depot, go back a long way. And the thing is, there wouldn't be any Floor Decor if these guys were already providing the full range. The fact is, when you go to Bunnings, they're not specialists in flooring. It's a broad, you go in, it's your one-stop shop for everything, but that also limits, what you can provide, your SKUs, as they say, the variety of products you can buy. And so, I don't know whether they have 2,300 products, but, that's essentially where Floor Decor is. They are the specialist. And if you read, there's some books on, business theory that basically say over time, industries tend to fragment into specialists. And so this is a good example of that. So if you're, you don't really care about your flooring, if you just want half a dozen choices and you just want to pick the economical one, or maybe there's one flash one expensive one, then you go to Home Depot. But if you want to choose from 500 different ones and you really want to make flooring the main thing of your home, then you're going to go to Floor Decor, just because it's the specialist, and that's the opportunity. And the other thing I'd say too is Tom Taylor is ex Home Depot. He wasn't the CEO, but he was basically the next best thing. And he was there for, I think it was 25 years or something. So he knows who he's competing against. And so when he took the job at Floor Decor, he knew exactly what he was up against, and he knows everything they do. And he clearly figured that he could take them on. So he's been doing a good job so far, and we're backing him in.
Nice. So Nathan, to close out, when thinking about Floor Decor, what are some of the risks, or perhaps, what is going to blow the thesis apart? Is it just simply a matter of that they're not rolling out as they said they would, or are there other key sort of elements to it? Yeah,
I mean, the first one I always ask myself is just competition. Is someone else going to come and start up and start building the same specialized huge stores? That's the number one thing you're looking for. The second thing is just a problem with the rollout. If you started to see that the stores weren't as profitable as the store network matures, that would be a big red flag, because that's telling you that America doesn't need 500 Floor Decor stores. 170 is probably enough. So, and the thing is, if those stores aren't maturing and those profits from those stores aren't growing, then that's less money you've got to reinvest in that store rollout. So all of a sudden, if you've built your DCF spreadsheet and you've got 500 stores in by 2030, all of a sudden, even if it's just delayed by 3 years, for example, then your discounted cash flow statement is going to be very sensitive to that change. In the short term, I'd say it's probably just more around a recession. People may not want to go and spend $30,000 on reflooring their house if people start losing their jobs. But to me, that would only be, that's just a temporary cyclical factor, and that's any opportunity to buy this stock on the cheap from that opportunity would be fantastic. I'd be cheering for that. It's more always about competitive advantages. Is anyone going to come and steal the profits and reduce the profit margins? Especially when you're paying 30 times earnings for a business. I don't say that lightly. It's very rare that we pay that sort of multiple for a business, but these are just two, I think, pretty spectacular opportunities where it's worth it.
Now, Nathan, that does bring us to the end, but we have one more question for you. And every year, Equity Mates hold the Equity Mates Awards, where we celebrate products, platforms, and people that are making financial markets more accessible to us as the retail investor. And as an expert, one of the first for the year, although we did have Andrew Brown, but you are now in the running for the highly coveted trophy of Expert of the Year just by appearing on the show. And it's voted by the community. But we want to know, if you are lucky enough to win, where will you be putting the beautiful glass trophy that we send out at the end of the year?
Sounds like my downfall's imminent. How about I put it in the background there for you, so at least you can see it?
Nice.
Perfect.
I was hoping for that answer.
As we finish up, just a reminder that the fund IISV is a compilation of international and local equities of quality businesses at undervalued prices. Intelligent Investor just launched their fund, so if you are interested in checking it out, use the link in the show notes to find out more information. Nathan, it's been an absolute pleasure. Great to chat with you again in 2023 and to get us thinking about 2 international stocks.
My pleasure, guys. Thanks again.
Thank you very much.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.